You may have heard that dollar cost averaging is the safest way to invest. So you're set on dollar cost averaging, but how often should you buy into your investment? Every quarter, every month, every week, maybe every day? At what regularity would optimize your investment growth while also reducing the volatility in your portfolio? Well, I crunched the numbers and let's see what the optimal dollar cost averaging strategy will be. I pulled up a data set for an up year for the stock market and a down year for the markets. Dollar cost averaging during up and down years will happen, and you should know how your strategy performs for each. I then chose 4 different dollar cost averaging strategies, investing every quarter, every month, every week, and every day. I also included lump sum investing as our constant to see if any of these dollar cost averaging strategies work better than lump sum investing. In this simulation, we have a hypothetical $100,000 to invest. First, let's look at our up year. Quarterly, we see a 15% return. Monthly, we see a 12% return. Weekly, we see an 11% return. And daily, we see an 11% return as well. As you can see, during an up year, the less frequently you invest, the better your performance. Quarterly gives us a return of 15.29%, but is that better than lump sum investing? Unfortunately, during up years, lump sum investing does much better, 30.43% versus 15.29% for quarterly. Okay, so what about down years? Which dollar cost averaging strategy does better? Daily, you lose 14%. Weekly, you lose 14%. Monthly, you lose 15%. And quarterly, you lose 17%. As you can see, during a down year, it's the exact opposite. Investing more frequently reduces your loss, with daily investing being the least painful. Of course, during a down year, none of these dollar cost averaging strategies will net you a positive return, but a more frequent approach does reduce the losses. And what of lump sum investing during a down year? Lump sum investing during a down year performed the worst, negative 23% versus daily, negative 14%. What can we conclude here then? During up years, you should invest lump sum at the beginning of the year, and down years, you should invest daily. But life doesn't end up that way. How would you know whether a year will end up being a good year or a bad year? That means we need to look towards historical returns all the way back to 1928. Since 1928, the bond market has been up 67.03% of the time, meaning it has been down 32.97% of the time. If we get each dollar cost averaging performance and plug into our historical ups and downs, we have some solid numbers to go by. Quarterly, 4.59% average yearly return, monthly, 3%, weekly, 2%, and daily, 2.67%. We see that regardless of the type of year it ends up being, the best dollar cost averaging strategy in the long term is investing every quarter. But how does that stand up to lump sum investing? Because the market is up most of the time, lump sum investing is still the optimal investing strategy for buy and hold investors. Lump sum, 12.7% yearly average, quarterly, 4.5%, monthly, 3.2%, weekly, 2.7%, and daily, 2.6%. There you have it. Lump sum investing is the best way over the long term. But if you're sure you may not be able to stomach too much volatility, there's always a dollar cost averaging strategy. The best dollar cost averaging strategy, at least according to ones I looked at in this video, buying every quarter, 4 times per year, is the best way to invest. So what are your thoughts? Do you dollar cost average? Comment below. And as always, take care of your money.